Okay, it looks like we're live. Good morning, everybody. I am so excited to be kicking off day 3 of IIREC 2021. My name's Anthony Walker. And today, if you don't know me already, we're going to be talking about a lot of stuff that's a little bit different from what we've covered so far in the conference. So we spend a lot of time at these sorts of events talking about cap rates and deals, the direction of the market, interest rates, LP, GP splits, underwriting, asset classes, all this kind of stuff. But a lot of times we don't take the time to sit back and just think about why we're doing this to begin with and why we're sitting here, frankly, on a Sunday morning at a virtual conference when we could be outside if the weather is nice where you are, like it is for me in Southern California. So let's take a step back and look at the big picture with me for 30 minutes, and hopefully you enjoy this. So we're going to talk about creating multi-generational wealth through real estate. I'm going to back it up a little bit. I'm going to cover some information that I think is probably review for almost everybody on here, but I'd like you to challenge yourself for a minute and just go through a couple thought experiments with me. And we're not going to talk about, cap rates and stuff like that for just 30 minutes. So a little bit about me first. I'm originally from Minneapolis. I moved out to LA to get out of the cold 21 years ago to go to undergrad and stayed. Worked in the insurance industry for almost 10 years. Really was just not happy with corporate life. And so I went to business school to try and figure out what kind of business I could start that would be scalable, develop passive income, and have a minimal number of employees. I'm sure that sounds familiar to a lot of you. So settled on real estate. And through my network there at school, I met a company called Buckingham Investments and started as a client 11 years ago now, bought my first little duplex with them. And I was really struck by the company's approach. It's really a generational real estate company that's been around since the 1960s, focusing on just building long-term wealth for clients. It's a brokerage company at the end of the day. We're not a syndicator, although we've done that in the past. We're just focused on helping clients learn, plan, and invest mostly in multifamily real estate in Southern California. So I started as a client. I bought myself my first little duplex way back then. This is an ugly duckling, so to speak, in Long Beach. And I bought this for $300,000, scrimped and saved from my corporate job, tax refunds, year-end bonuses, plopped it down on this guy, and owned it for a little while. It did its thing. Exchanged it into this beautiful 5-unit, or not so beautiful, 100-year-old building right down the street. Not the best area, but again, it did its job. Exchanged it into this, and now we're kind of talking. So over time, I've developed a portfolio of 15 buildings. I invest mostly in the Long Beach, California market, but a little bit all over kind of the LA, Northern Orange County is really our specialty. And I just invest myself. I've done syndications in the past and partnerships, but these days I've been able to develop a pretty sizable portfolio just with my own equity, which is great to have my own control and call the shots. I don't have to write any investor updates. So that's pretty nice. So I'll share a little bit about my experience here and sort of our philosophy and our strategy and how you might want to take away a little bit about the way I look at property for perhaps your own portfolio. And this is going to be relevant to anybody here, whether you're a limited investor or a GP with tons of experience. It's really good sometimes to take a step back, look at the 30,000-foot picture a little bit, and maybe take a minute to think about where your own portfolio is. So why am I showing you a Finance 101 slide right now, right? Everybody knows what time value of money is probably if you're at this conference. But just bear with me for a minute and let's review. So the equation, future value equals present value times 1 plus the rate of return to the power of n, where n is the number of years your investment compounds, right? Simple enough. Well, let's unpack that for a minute, okay? So we all know that when you graph it and you put it on your cocktail napkin graph like we have here, the compound interest formula looks great. You get that exponential curve, so the longer you invest, the growth of your money accelerates, right? So, but if you look at the equation, you can see that that n number by far is going to be the most sensitive variable. And why? That's because you've got the exponent, right? It's exponential math. So that's it. Any number in the exponent is by far going to be the most important number in this equation. So let's keep that in mind as we move forward. So now let's get that poll out there if we can. Real simple question for everyone. Do you have an investment plan written down? And it can be one sentence, just like this. That's great if it's 50 pages long and it's got projections on cash flow and equity positions and tax shelter benefits and how many doors you're going to have or whatever, assets under management. That's wonderful. But do you have just a super simple general investment plan? And all the investment plan has to be is a word version of the time value of money equation. I'm going to invest present value dollars for N years in real estate investments at a sustained rate of return of R%, and I'll be worth future value dollars at the end of the plan. Super simple, right? So everybody yours doesn't have to look like this, but the poll should be live right now. I'm really curious to see how many people actually have an investment plan written down. And be honest, it's okay if you don't. We'll get you one by the end of this 30-minute session. Super simple, okay? So you can manipulate these variables. You can decide based on how much you have today, how long you're willing to wait, what you want to be worth in the future, and then, of course, what we think a reasonable expectation would be for our rate of return over time. So that's what we're going to work on. Now, this is really just a financial calculator on paper right here. That's what the time value of money equation is all about, right? So you can play with some numbers, plug them in. This has nothing to do with real estate. This would apply to any investment where you can get these types of returns. But just look at this for a minute with me. So let's say you invested $200,000. That would be your down payment or your present value for 10 years. If you could get a return on equity of 25%, which I know sounds crazy, you'd be worth $1.8 million at the end of 10 years. But only 5 years later, that triples to 5.6. 5 years after that, triples again to 17 million. Now it's starting to look a little more attractive, right? So now you're starting to see why this is called creating generational wealth through real estate. You start to be able to see the shape of this graph when you look at those numbers. So this might look ridiculous to people that I show you a chart starting at 20%, but bear with me for a minute. Not everybody has looked at this in the same way in a while. All right. So we've all seen this before. If you've seen a basic YouTube video on real estate investing, then you know this stuff. So I'm not going to belabor the point on the 4 elements of return: appreciation, cash flow, equity buildup through amortization, and tax benefits, right? Add all 4 together and you get that R number in your time value of money equation. Something, though, to consider, right? Appreciation and cash flow. There's always a trade-off there between the two. So we talk about high yield markets, low yield markets, appreciation markets versus cash flow markets. So you might want to think about some of this stuff as you kind of select your investments. Cash flow in general, here's a good rule of thumb just to move along as we start talking and getting into some scenarios here. In our market, you should be able to get a cash return on equity of about 5%. That's different than cash on cash. So I want you to remember that. At any given point, your equity changes every year, right? Cash return on equity of 5% should be doable in most markets. If it's doable here in Southern California on stabilized properties, it's probably doable almost anywhere, except for maybe, I don't know, San Francisco and New York City. But I'm sure it's possible there in the right buildings too. All right? So with that in place, let's look at 50 years of values. So right here is a chart. This is why I was so excited to come on board at Buckingham. This is a value chart going back to 1965 of apartment building values. In 1965, buildings, this is from about LAX down through Long Beach, so Southern LA County, 2 units and above. We've been doing that research ourselves for 55 years. So 1965, we were at $14 a square foot. In 2020, we just finished our market research for the year, and we ended at $422 a square foot. And if you just smooth this out over basically 5-6 business cycles at this point, our 55-year average rate of appreciation every single year over the long run is 6.4%. Now, that's pretty good. Obviously, real estate is susceptible to business cycles. We talk about that all the time. We had downturn in the early 70s, and then a lot of appreciation, downturn in the early 80s, early 90s. Then we had the subprime boom. Then we had the subprime crash. And now here we are, 10 years into an expansion market, and we're in COVID, and we don't really know what the heck is happening. So I'll leave those forecasts to the experts, but historical data is really interesting to look at. One thing I love about this chart is real estate values are not necessarily tied one-to-one to the stock market. There's a missing cycle in here if you talk about recessions. So in 2001, right, we had the dot-com bust, and we went into a recession in this country. you can see from the chart here, real estate values just basically ignored it. It didn't really touch us. Obviously, the subprime crisis, totally different story because we caused that one. So very different. So understanding that first element of return, appreciation, we're going to talk about that a lot because we're talking about growing generational wealth. And if you want to copy this research, feel free to reach out. We can give you a lot more than this. We have some downloadable stuff at our sponsor booth as well. So let's talk about leveraging appreciation. We talk about leveraged cash flow, operating leverage. So you want to have a higher cap rate than your cost of funds or your interest rate. That's a popular topic. But leverage appreciation is a real thing too. And a lot of people learn this when you went and did your first real estate education, whenever you got started, whenever that was. But we forget this too. So remember, if you put some money down and you borrow some other money, you multiply your return through leveraged appreciation. So just a simple example here so we're all on the same page. Let's say you had $300,000 down to start with. You could buy a property all cash because you were raised to believe that all debt was bad, and if you can afford something in cash, then you should do it. So you could buy a $300,000 property. That got me that first little duplex 10 years ago. Pretty hard to find a $300,000 duplex these days in LA, but we'll use it for the example. If that only appreciates at 5%, which is less than our 55-year average, you make $15,000 in your first average year of appreciation. And in year two, your property's worth $315,000. Your ROE in this case is appreciation divided by down payment. 15,000 divided by 300,000, or surprise, surprise, 5%, the same as the appreciation rate in the market. Now, let's say instead you took that same $300,000, you use that as a down payment, you buy a $1.2 million apartment building. That gets you a good size 4-unit in our market. And you make sure that you buy one that pays for itself and all that, maybe a little bit of cash flow on the side. That $1.2 million building also goes up at 5%, just like the $300,000 property. That's $60,000 in your average year. Average year one to average year two value would be 1.26. And now the math is appreciation, $60,000 divided by down payment, not the purchase price, right? So you make 20% on your money. Super simple example. It's a cocktail napkin trick. I'm sure everybody has seen this before. So now that we've kind of set the stage, let's look at some scenarios that maybe you haven't considered so much. So here's that same purchase. Here's a 20-year forecast of how that investment would look if you just bought it and held on to it and did nothing. So you just manage this. Let's look at how the math changes every year. So we skip years here to fit it on the slide. This is just buying that one property, 5% appreciation. We're just ignoring any conversations about cash flow, principal pay down, tax benefits. This is just appreciation at this point. And I understand there are fluctuations in the market, but we're just working with long-term averages here because we're talking about building a long-term portfolio and creating wealth. So in year two, once that property is worth 1.26, goes up by 5% again, that's 63,000. 63,000 divided by your first year equity plus the equity increase from year two is 360. That's 17.5% ROE in year two. So this is where it starts to get really important. And if you've heard me before, I talk a lot about ROE every year. So this is a different metric than we're used to using. When in the syndicated space, I understand it's important to talk about IRR and profit splits and all that kind of stuff, but you can apply this math to your portfolio however it's invested. And a lot of people don't look at it this way, and I think you should. Look what happens as you move along. ROE just gets diluted every year a little bit more. As the denominator or your equity goes up, you get deleveraged. So by the time you're at the 20th year, your equity is 2.2 million, your ROE is 7%, and your total ROE is only 11%. So that's fine, but not that great. Now, what if instead you tracked where your equity was every year and you managed your ROE over time? So here's another forecast, same initial investment, but you exchange every 4 years. So you start at 20%, you get deleveraged down to 14.2, and then at the beginning of year 5, you take 558,000 from a sale. I know there's transaction costs for simplifying the math here. You invested in a new purchase with 25% down, and you re-leverage, and your return goes back up to 20%. And you keep playing that game and re-leveraging, and look what happens to your total ROE over that 20-year life of your portfolio. At the end, your equity has gone from 300,000 to 6.7 million in $17 million worth of property. So the cash flow there, even if it's a low percentage in whatever market you might be on, 5% of 6.7 million is pretty good. You know, what's that? $335,000 a year in passive income. That's with one initial investment of 300,000, adding no other cash to your portfolio over time. So let's just look at how this plays out if we compare these real quick. Investment number one, a little over 2 million after 20 years, and then Releveraging and buying more property, look at that. You're worth almost $7 million after 20 years. That's the impact of releveraging, managing your ROE, and making sure that our number and the time value of money stays strong. Okay, so what now if we start adding some of these other elements of return into the picture? So I'm oversimplifying the math here just to make this really easy, but let's assume that we've got that 5% average appreciation rate, and then by reinvesting cash flow, a little bit of principal pay down, and the financial discipline of saving some of the tax benefits and buying more property, you can get to an 8% total unleveraged return. With an 8% property level return and applying the same leverage, look at what happens to the numbers. You can average an ROE on a portfolio like that of 25% every year over 20 years, and $300,000 can turn into $26 million with no additional investing. Let's compare how this looks here compared to the first two examples. Wow, what an incredible impact, right? So it makes a lot of sense to reinvest whenever you can. If you don't need the money right now and you're really talking about creating long-term wealth, look at what happens for the future. So if you have this kind of time on your hands, even a little bit less, incredible. 5% of 25 million, over $1.2 million in passive cash flow. Wow, that's insane. I'm excited right now because I got my multifamily portfolio started about 10, 11 years ago, and I'm like here. And I've been doing this the whole time. So now I've got like 15 buildings. I'm moving along. I can do multiple transactions a year. And the numbers are eye-popping all of a sudden. I cannot believe it's real. And I'm investing in a super low cash flow market. This can work absolutely anywhere. It's ridiculous. So now let's talk about a couple pitfalls that people often fall into when we get into real estate investing. We call this the stock market mentality at Buckingham. So I understand how this happens. If you've invested in stocks, you basically have to pick a winner. So what this is here, this is a chart of the S&P 500 going back to inception from 1957. You can't see where it starts there at the beginning. The 63-year annual compound return on the S&P is higher than our appreciation rate on properties, but it's really difficult to leverage that without a ton of risk. That's basically your total return. So 86% of the original S&P 500 companies are still in business at all as of 2007. There was a 50-year article I read touting how incredible that was. Well, that's not that good at all. That's a 17% chance that if you had bought those, if you had tried to pick a winner in 1957, you had a 17% chance of picking a company that was still going to be in business at all in 2007. And I bet there's a lot fewer now because, that was before the 2008 crash. So what gets a lot of people into trouble here is taking this same mentality to real estate investing, feeling like you got to pick a winner, you got to buy low, you got to sell high, you got to time the market, you have to pick the perfect area. All that stuff is important, and obviously we want to do the best that we possibly can for our investments, but that can cause that analysis paralysis. It can cause you to sit on the sidelines, and you can lose out on a ton of extra numbers in that N exponent on the time value of money equation. So we call this the dilemma of a good deal. So let's check this out. So we went back through our old records at our El Segundo office. We've got old MLS books going back decades, and we found basically two almost identical properties in Hawthorne. This is right by LAX if you don't know the area, kind of a low income basic, 4-unit properties here. And we found the best and the worst 4-unit deals of 1989. These are very similar properties. So the best deal went for $469. That person really got a steal. The worst deal went for $525. Now let's just do a little example here and fast forward 31 years to 2020. Similar property today is worth about $1.6 million. Your down payment on each of these would have been $93,000 versus $105,000. Not a whole lot different. And your gross profits from sale, very minimal difference. Your total return just owning one building versus the other is less than 0.5% more getting the best deal. Okay, so if we understand this, let's see how it looks over time. What if you waited a year to buy the best deal? So this was 1989. You waited until 1990 to find that absolute steal, and you were so stoked you found the very best deal, right? So you bought that building, and then you used our releveraging strategy to continue to exchange and refinance Whether you exchange, whether you refinance, the math is actually the same. I see a question in the chat about transaction costs and stuff like that. This works with refis as well because you're re-leveraging your equity. So whether you're selling the building or keeping it, it can work the same way. And obviously you have to work the transaction costs into this stuff. This is simplified math. But if you waited a year and got the very best deal and then you employed that strategy, your equity would be about $7 million 31 years later. If you bought the worst deal, as soon as you saw it, you would have made $2 million more just because you started a year early. Doesn't feel like it makes any difference at the beginning of your investment life cycle, but in that 19th to 20th year or 30th to 31st year, when you're making multiple millions of dollars every year because you started 1 year early, it literally doesn't matter that you bought the worst deal on the whole market. Obviously, this is a simplified example, but this is the trap a lot of us get into. It's more important to participate than to feel like you stole something. Okay, so now let's look at another example. So I have a hilarious little prop for you guys right here. And I'm sure you can't read this, but this is an old MLS card. This is what the MLS used to look like in 1979. This is a duplex listing in Lawndale that we have from our old files. We had a card stock of MLS listings back then. And here's this same property. You can see the photo. You can see it's the same building that we have on the screen. 156th Street, little basic duplex in Lawndale in 1980, sold for $95,000. And in 2020, that's worth about $836,000, right? Great. Okay. What about this one? Here's one in Hermosa Beach. So if you know LA well, you know that Hermosa Beach is an A-plus type area. This is a block from the beach in, Volleyball Central, best property you could have ever owned. It's experienced incredible appreciation over the last few decades. And if I told you could buy something a block from the beach to Hermosa Beach for $260,000 in 1980, and it's worth $3.8 million now, almost everybody would say that's the one I want. Oh man, you really picked a winner. Yeah, grand slam. Forget the Lawndale property. That's the one you should have bought. It's worth it. Let's unpack that a little bit. Okay, 1980 to 2020 appreciation comparison. So the Hermosa Beach property sold for $260,000. The Lawndale property sold for $95,000. The annual appreciation rate on Hermosa Beach was stronger. The data bears that out. It appreciated at 7%. Lawndale appreciated at 5.6% average every year. So it's less. So, right, you should have bought the Hermosa building, right? Maybe not. So 2020 worth $3.8 million. Lawndale's worth $836. If you just held on to each one of those properties and sold them, you would have made $3.5 million from Hermosa and $741,000 from Lawndale. Cash down to break even though. On Hermosa Beach, because it's such a low cap rate purchase, it took 50% down to break even. On the Lawndale property, it took 25% down to break even. So there definitely becomes a point where you can get too low, you can go too nice on your market. If you can't use that kind of leverage that we were able to take advantage of in our earlier examples, you can really hurt yourself. The math cuts itself in half on your actual ROE, your appreciation on equity, even though the property's appreciation is better. So in this example, what if we took that same $130,000 and we bought 5.4 Lawndale duplexes? Now, I know it's not possible to buy 5.4 duplexes, but just bear me out here so the math matches. Just because of the leverage, even without re-leveraging at all, you would have been able to make $4 million of profit with no extra cash flow. And believe me, the Lawndale properties would have cash flowed more, versus $3.5 million in profit on the Hermosa Beach property selling it 40 years later. Isn't that amazing? And watch what happens when we chart this out. Here's a 40-year chart. So we're really starting to talk about multi-generational wealth at this point, right? Here's the Hermosa Beach property. You can see the scale of the chart and you can probably guess where this might be going. So from 1980 to 2020, if you re-leveraged every 4 years or so, and you put 50% down and you kept buying Hermosa Beach property and you experienced that better than average market appreciation of 7% on the value of property, you'd be worth around $25 million 40 years from now. That's a lot of money. That's great. But what happens if you bought 5.4 Lawndale duplexes and you exchanged at the same rate and you put 25% down with every exchange and you re-leveraged? You would probably own most of the city of Lawndale by now, so you would have had to expand a little bit over the years, but you would be worth over $200 million in equity 40 years later. This is what is so insane about this strategy. It seems like nothing is happening at the beginning. It seems like it's not working that well. We've met so many clients that have just been frustrated with their investments because they bought a few properties and they feel like it's so difficult, and maybe they self-manage, and it's just, when does this get fun? When does this get large? When do I start really experiencing life-changing cash flow? And it's because of this type of mentality. They feel like they have to steal the properties, they have to buy the very best deal, and they're scared of debt. And so you end up with a small portfolio. You can put a life together on that if you've got good income from other sources, and you can do well. But if you really want to create multi-generational legacy, family changing wealth, you've got to control your ROE, and you have to track this and do your portfolio analysis every year. It is insane what you can do when you really stretch out the timeframes on this stuff. And this is just using average year math, actual historical data. These are not particularly winning properties. These are just old, MLS cards that we found in a box from actual sales. There's no magic about this at all, but that's literally how it works if you participate and you execute intentionally over this long. It's insane. So think about the cash flow on $200 million in real estate. I don't care how low the percentage is, that's going to be enough to take care of you and your heirs for generations to come, right? So if you haven't looked at this, sit down, look at your portfolio. Doesn't matter whether you're a limited partner in other investments, you're a GP, you're a sponsor, you're managing a fund, or you're a direct investor like me. Take a systematic approach to your portfolio, step back and look at the bigger picture. Think about Finance 101 for a second, and let's get out of all the talk just for a day about all the details of the deals and everything, and remember why we're here on a Sunday morning to begin with. So with that being said, I'll give you a couple more nuggets here from our history. This is a really great topic, I think, just judging from what we've heard so far in the conference, because it seems like we're going to be in a prolonged period of low interest rates, probably low cap rates, low yield investing. And there's been a lot of talk here from various panelists about maybe thinking a little bit more about building wealth, building equity, asset values, becoming a little bit more important than cash flow. So I think it's incumbent upon us to take this sort of approach, have a look at your portfolio strategy, and execute a little like this. So on that topic, let's talk about inflation. So the last time we experienced really serious inflation, and I don't know whether inflation's coming back aggressively anytime soon. There's been a lot of talk about that too. It's anybody's best guess. We think interest rates are going to remain low for a really long time, 5 years or so, but probably eventually, right? We're going to have to see that inflation come back from the trillions of dollars we're pumping into the economy right now. You have to go back really far, probably earlier than almost anybody here's memory for investing, to see an environment where inflation grew as much as it did in the 1970s. And look at what happened last time this happened. You had interest rates ticking up from 7% to 16% in 1981. And during that time, did prices crater because interest rates trickled up? No. They went up by 406%. Absolutely insane, right? We can't really see that in this chart because the scale of the chart, it looks like that wasn't a big deal. But that's a way larger boom than the entire subprime boom put together, 400%. So if that's coming in the future, can you really afford to sit on the sidelines? So thank you for joining me today for this presentation. I got a minute and a half. If you want to put some questions into the chat, that'd be great. I'll try and answer some really quickly. If you're interested in hearing more about our sort of philosophy and our strategy, whether you're investing in Southern California or anywhere else, I would love if you would join us on March 13th. Our company is putting on a all-day symposium on a Saturday with all kinds of information about planning, research, tax strategies, accessory dwelling units. We have some incredible guest speakers that are some of the best experts in the space, and we would love to have you join us. This is free. Again, my name is Anthony Walker. I'm the CEO of Buckingham Investments, and it's been a pleasure. Let's see if we've got any questions here. So yeah, we had the one on transaction costs. We can definitely model how it works with transaction costs for if you're going to exchange versus refinance. The math was really simplified there. And we would do that for any detailed portfolio analysis. We have to look at that. David Coe asked 1031 versus refi. What's my favorite way to re-leverage? It all depends, right? So there's really two things you have to look at. You have to look at a max cash out refi scenario for your property. How much can you get out? Does your property support the debt? Will you be able to re-leverage effectively? If the answer is no, you should probably exchange. Or if you're not going to net enough out of a refi, an exchange is a better answer, but a refi is cheaper. So if you will, that's the answer.